Have you ever wondered what truly makes the stock market tick? Beyond the headlines and the company reports, there's a powerful, often invisible force at play: the sheer speed of modern trading. Today, we're going to pull back the curtain on two fascinating and sometimes controversial concepts: high-frequency trading and front-running. Let's begin with high-frequency trading, or HFT. Imagine the stock market not as a slow-moving ocean, but as a colossal, hyper-fast river of information and orders. HFT firms are the undisputed speed demons of this river. They employ incredibly powerful computers, often located mere feet away from the exchange's own servers, a strategy known as co-location. This isn't just about fast internet, it's about minimizing the physical distance data has to travel, giving them a minuscule yet critical advantage in time. We're talking about trades executed in microseconds, a millionth of a second, or even nanoseconds, a billionth of a second. That's faster than your brain can even register light. Why this obsession with speed? HFT firms use sophisticated algorithms, essentially highly precise sets of computer instructions, to identify and capitalize on tiny fleeting opportunities that appear and disappear in the blink of an eye. Their strategies are diverse, but here are some of the most common. Market making. This is perhaps the most fundamental and arguably the most beneficial HFT strategy. Think of market makers as digital shopkeepers who are always willing to buy or sell a stock. They constantly place both buy orders, bids, at a slightly lower price and sell orders, asks, at a slightly higher price. Their goal is to profit from the tiny difference between the bid and ask price, known as the spread. By providing continuous bids and asks, they add immense liquidity to the market, making it easier for you and me to buy or sell shares quickly without drastically moving the price. They absorb small imbalances and facilitate smoother trading. Arbitrage. HFT can also exploit minuscule price discrepancies across different exchanges or even different securities. For example, if a stock is fractionally cheaper on one exchange than another, an HFT firm might buy it on the cheaper exchange and simultaneously sell it on the more expensive one, profiting from the fleeting price difference before it corrects. This often helps to ensure price consistency across markets. Statistical arbitrage, event-driven strategies. These are more complex. HFT algorithms might analyze vast amounts of data, news headlines, economic reports, social media sentiment, looking for patterns or predicting how prices will react to specific events before the broader market can. They then place orders to capitalize on these predicted movements. Now, while HFT generally enhances market liquidity and can lead to tighter spreads, meaning you pay less for your trades, it's not without its critics. Some argue it creates an unfair playing field for slower investors, contributes to market volatility during certain events, and raises questions about market fairness. Which brings us to our second term, front-running. This is where things get genuinely problematic. Unlike HFT, which is generally legal and regulated, front-running is illegal and unethical. Imagine this scenario. A large institutional investor, let's say a big pension fund, wants to buy a massive block of shares in Company X. They instruct their broker to execute this large order. Because it's such a large order, the broker knows it will likely push the stock price up significantly once it hits the public market. Front-running occurs when that broker, or someone with insider knowledge of that large pending order, places their own order for the same stock before the large client order is executed. They essentially jump the queue. Once their smaller personal order is filled, they then execute the large client order, which drives the price up. The front-runner then immediately sells their personally acquired shares at the now inflated price, profiting from information that was not publicly available. Think of it like this. You tell a friend you're about to buy 100 tickets to a popular concert, knowing it will sell out fast and drive up resale prices. If your friend then immediately buys 10 tickets for themselves before you buy yours, intending to resell them to you or others at a higher price once the initial sale is complete, that's front-running in concept. The core difference between HFT and front-running is the source of the information and the intent. HFT relies on speed and public market data to react to fleeting opportunities as they appear. It doesn't rely on privileged knowledge of private, unexecuted client orders. Front-running relies on privileged, non-public information about a client's pending trade to gain an unfair advantage. It's a breach of fiduciary duty and market integrity. Regulators like the Securities and Exchange Commission, SEC, in the US and financial authorities globally vigorously police front-running. It undermines investor trust and distorts fair market pricing. In conclusion, HFT is a technological evolution of market making, a high-speed dance of algorithms providing liquidity, largely legal and regulated. Front-running, on the other hand, is a malicious exploitation of confidential information, an illegal act of betrayal that harms market integrity. Understanding the difference is key to navigating the complex, fascinating, and incredibly fast-paced world of the modern stock market. Thank you.